All right, students, welcome. Today, we're going to open up Chapter 5 of the Trading Academic. This is all about building that foundational knowledge you'll absolutely need for your Level 4 studies, so let's get right into it.
So let's start with a big picture question. You look at a screen, right? You see stocks, you see bonds, oil. They all kind of just look like wiggly lines going up and down. But what are you actually looking at? What's the real DNA of each of these markets and what really truly makes them tick? That's what we're here to figure out. Here's our roadmap for today. We'll start with a primer on what an asset class even is. Then we're going to take a tour through the big ones: equities, bonds, forex, and commodities. And definitely stick around till the end because that's when we're going to connect all the dots and see how these markets are all locked in this constant, intricate dance with one another. Okay, first things first. Before we can really dig into the nitty-gritty, we need to be on the same page with our definitions. What exactly is an asset class? You can think of these as the fundamental families of the investment universe. It's kind of like biology, you know? You've got mammals, reptiles, birds. They're all animals, sure, but they operate under completely different sets of rules. It's the same in finance. Each asset class has its own ecosystem, its own drivers, and its own unique set of behaviors. So let's start with the one most people are familiar with, the one that always makes the headlines: equities, or as you know them, stocks. And this right here is the absolute key. When you buy a share of a company like Apple, you're not just trading a symbol on a screen. You are literally buying a tiny fractional piece of the entire company, a claim on its profits, its assets, its future. That's why stock prices are so sensitive to everything from big economic news down to the slightest rumor about a new product. And the scale we're talking about here is just immense. The total value of all public companies is over $126 trillion. Just to put that into perspective for you, that's way more than the entire planet's annual economic output. This isn't just a market, it's a huge chunk of global wealth. Now, here's where the internal mechanics, the microstructure, have gotten really fascinating. We've seen this explosion in what are called zero-day options. Basically, super short-term bets on where the market will be by the end of the day. And they have totally changed our market's move intraday. Imagine, the big banks who sell these options have to constantly buy and sell stocks throughout the day to hedge their risk. This creates these huge artificial waves of buying or selling that can pin the market at a certain price or cause these sudden, violent moves out of nowhere. Okay, so if equities are all about ownership, let's flip the coin over and look at the other side of the balance sheet: debt. Let's talk about the bond market. And here's a fun fact that surprises a lot of people. For all the attention that stocks get, the bond market, well, it's actually bigger. It's a monster at over $130 trillion. If stocks are the flashy, exciting part of the financial system, you can think of bonds as the critical plumbing that holds the whole thing together. So why do we care so much about bonds? Because they send these incredibly powerful signals about the health of the economy. And the most famous signal of all is the yield curve. Look, normally you'd expect to get paid more interest for lending money for 10 years than for just 2, right? But sometimes that flips. It inverts. That means lenders are so worried about the near-term economy that they demand more money for short-term risk. It's basically the market shouting that a recession could be on the horizon. And historically, it's been right almost every single time. All right, from the world of debt, let's zoom out even further to the single biggest, most liquid market on the entire planet: the foreign exchange market, or Forex. The numbers here are, well, they're just hard to even comprehend. Every single day, $7.5 trillion changes hands. That's the entire annual budget of the US government, being traded every couple of days. This market never sleeps. It's a 24/7 global river of money, constantly flowing between countries, all driven by things like trade and interest rate policies. And that brings us to a classic Forex strategy, the carry trade. The logic is beautifully simple. You borrow money in a country with super low interest rates, say Japan, and then you invest that money in a country with high interest rates, like Australia. You just get to pocket the difference, the carry. It works great when markets are calm and happy. But the moment fear takes over, everyone scrambles to unwind these trades at the same time, and they can blow up in a really spectacular, market-shaking way. Okay, so from the abstract world of currency exchange rates, we're now moving into the very real, very physical world of commodities. We're talking about actual, tangible stuff here. The oil that goes in our cars, the copper in our walls, the wheat that makes our bread. What moves this market isn't a company's earnings report. It's real-world supply and demand.
A war in the Middle East sends oil prices flying. A drought in Brazil does the same thing to coffee. This is economics at its most raw and elemental level.
Now, commodities have this really cool and unique feature called the futures curve. Usually, a market is in contango. That just means it costs more to buy oil for delivery a year from now than for delivery today. That makes sense, right? You have to pay to store it. But sometimes the whole thing flips into backwardation. That's when oil for delivery right now is more expensive. And that is a powerful, powerful signal. It's the market telling you that there's a shortage and people are literally willing to pay a premium to get their hands on it today. Okay, so we've taken a tour of the individual asset classes. But the real magic, the key to truly understanding how all this works, is seeing it as one giant interconnected machine. So let's tie it all together. This slide right here is probably the most important thing for your Level 4 studies. No market exists in a vacuum. For instance, when bond yields go up, that safe government debt suddenly looks a lot more attractive, which can suck money out of the riskier stock market. When the US dollar gets stronger, it makes dollar-price commodities like oil more expensive for everyone else, which can push commodity prices down. It's all connected. It's the connective tissue of the entire global financial system. And that leaves us with one final, crucial thought to take with you. If you really want to understand what's happening, you can't just stare at the stock market. You have to see the whole board. The real lasting edge doesn't come from knowing one market inside and out. It comes from understanding how a ripple in the bond market over in Japan can create a wave in the US stock market. And that, right there, is the great challenge and the great opportunity of thinking like a true market analyst.